Okay, good morning, everyone, and welcome to this morning's session of the Coffee Microcaps Morning Meeting. My name is Mark Tobin. I'm the founder of Coffee Microcaps. For anybody who is joining us this morning for the first time, you're very welcome. And for all our regular attendees, welcome back to this morning's event. I'm just going to quickly run through a couple of intro slides, and then we're going to get straight into it with our first presenter. Firstly, I'd like to mention our virtual event sponsor, DMX Asset Management. If you are looking for a smaller microcap fund manager, please check out the DMX funds and the relevant PDS and financial services guides on their website, or indeed email either Stephen or Michael for more information or those guides. And quick compliance and disclaimer slide. For anybody who's joining us for the first time, the companies we normally have presenting on here every Thursday are capped under 300 million, are in revenue and approaching cash flow break even, or indeed are already profitable. We generally don't have companies from the resources or the biotech sectors. So what I like to group as industrial microcaps, which encompasses microcap technology, microcap financial services, microcap industrial businesses, consumer businesses, anything basically outside resources and biotech. Structured this morning's webinar, we've got 3 companies presenting this morning. Each will have a 30-minute slot, which we'll roughly break down into a 20-minute prezzo and then 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. It just makes it easier for me to moderate the questions to our presenters. And please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel early tomorrow morning. You can follow us pretty much anywhere, Twitter, YouTube, as I said, for the recording. And indeed, we have about 100 other company presentations already up there on the YouTube channel, LinkedIn. And I also write a free monthly newsletter, which you can grab off the Substack platform. Up first, we're going to have welcoming back, actually, Roby Sharon-Zipser from Hipages. And then actually all 3 are returning guests. We've got Rod Bishop then joining us from Jayride Group. And then finally, we're going to finish up with Danny Nadri from Shekel Brainweigh. So that's enough from me. I'm going to stop sharing my screen. And Robbie, if you want to start sharing yours, I'll let you know when I can see it on screen. Yeah, looking good.
Good, great.
Yep.
Great. Over to me.
Yeah, over to you, Robbie. Good to go, mate.
Great, thanks. Good morning, everyone. Thank you for your time. I've got a relatively short presentation, give you an overview of Hipages, bit of a commentary on our results in FY22, and give you some color on what our outlook is for FY23. I'll talk to you a little bit about us now. So we are Australia and New Zealand's largest online trading marketplace and SaaS provider, creating effortless solutions that help tradies streamline and grow their business and delight their customers. Our purpose is to transform the trade industry and build better lives for everyone. Our vision is to be the most trusted partner in the trade industry. And this is really a good example of what we actually do for those of you that are not familiar with the Hipages business. Effectively, you put in our app or go to our website, a request for a trade service. We cover pretty much all services, everything ranging from cleaning to a brand new home construction and everything in between. The request kicks in our algorithms, which then relays that out to our tradie database or our network of trades. And the first 3 trades that respond present themselves to you, and you are then able to review those tradie profiles, message those trades, and then ultimately select the trade that you want to work with. We do a bunch of work in terms of vetting and verifying our trades, that they are appropriately businesses, licensed, rated and recommended, which is important as part of the trust elements that you expect from a marketplace. Moving on to the next slide, I'll just walk you through how our algorithm works. Now, our algorithm is incredibly complicated and is an essential component of our secret sauce as a business. However, I'll give you some color on it in the most simplest way possible. Effectively, when a job request from a consumer is put into our platform. It takes into account the distance the trades are from the job request, the recency of activity by the trades, the tier the customer is on our platform, as in the tradie, the tenure, are all taken into account in variables to optimize the 3 connections that you get as a consumer on our platform. Our monetization approach has been fully implemented now. We've been going for a number of years, tried many different approaches, and we've landed on what we believe is the superior and most optimal monetization strategy, which is to go 100% subscription. So we have in our platform in Australia over 31,000 trade businesses, all paying a subscription. And the way the subscriptions work is there are various tiers. This is just effectively a good sample or range of those tiers. They do go up to into the thousands of dollars of monthly subscriptions. These are generally annual contracts that are paid monthly. And within your subscription, you receive a bunch of inclusions. That includes a whole bunch of what we call lead credit. And when a trade accepts a lead, there's a charge which is used up against that credit. If a trade uses up all the credit in their subscription, that creates what we call an ascension opportunity, and we move them into a higher subscription plan. So those subscription products are really powerful because what it allows us to do, and I'll talk to it in future slides, is include more and more value into the subscription, and then ultimately creates more ascension opportunities for us to bring trades into different types of tiers or higher tier plans in our platform. In terms of the addressable market for the trade services in Australia, Hipages has done an incredible amount of work to understand the industry and effectively be the market leader in the on-demand tradie economy. In Australia alone, there's over $110 billion worth of work generated in the on-demand tradie economy. And about $1 billion of that is spent on advertising and marketing. And there are just under about 260,000 trade businesses servicing that $110 billion in Australia. We as a business take a relatively small share of what we are generating for the platform. Our overall take rate is under around 2.1%, maybe 2.5%, depending on how you calculate it. So we take a small share of what we generate of the market, which talks to the opportunity to generate higher ARPUs and revenues in the future. This is quite a comprehensive slide. I refer to it quite often. So if you've been in presentations with me, you'll know the ecosystem slide. I really, really like this slide, despite it having quite a lot of content on it. It effectively talks about the ecosystem, and the left-hand side, or the orange colors that you see on the left-hand side, is the total addressable market. Just for a quick reconciliation for the analytical people in the room, we mentioned earlier $110 billion. That's the Australian market, but on the left-hand side, we talk about $136 billion. We've consolidated the addressable market for Australia and New Zealand. So New Zealand's addressable market's about 26 billion, Australia 110 gives you the 136 billion. And then the right-hand side, the 97 billion, is the amount of money that the Australian trade service businesses spend on various services to manage and run their businesses. If we continue looking at the orange graph on the left-hand side, the work that's generated for those trade businesses comes from many different sources. The majority, or the biggest chunk of that, is the area that we specialize in, which is the home repairs and maintenance side of things. There is work generated through insurance, community and government, there's commercial work. We are very strong in that connection and getting the quotes and the communication piece, and we are working our way through our various technology solutions along those workflow management and material sourcing side of things. So there's more and more solutions that we'll be bringing into our platform over time. And then the right-hand side is we're looking at expansionary services to support the trade. So what more can we offer trades other than a marketing solution, now that we are the largest marketplace for trade services in Australia and New Zealand? Our strategy that I'll talk through in a little bit more detail now is talking about how we work our way through those ecosystems. We refer to it as Hipages 3.0. Again, I often find that there's a lot of analytical people in the room, so people are wondering to themselves, what is Hipages 1.0 and 2.0? So Hipages 1.0 is effectively our first 8 or so years of existence, where we were a directory business. The next 8 or so years has been 8 to 9 years has been us being purely a lead generation business, and Hipages 3.0 is looking to evolve our product into understanding the different types of journeys and requirements that consumers want, marrying that up with our trades, and then looking into those expansionary services that we can offer our trades, and then giving trades tools to help manage and run their business, particularly in our enablement section, which is in the black box. We refer to Tradiecore, and I'll go into a little bit more detail on Tradiecore in a second. In terms of understanding why, capturing consumer intent and the different types of products and services that consumers want, Hipages 3.0 is looking at breaking up that intent into different types of journeys for consumers. So just to explain, and so I'm not sounding like someone that's crazy on his thoughts on consumer journeys, it's very clear to us through our research that consumers have different ways and needs of wanting to work with trades. Everyone's different. Today, we really just have one primary way of connecting with trades, which is get quotes. We still offer our directory service, which is, our roots. However, we realize that directory and profiles is really important for many customers. People do sometimes like to take their time to review and look at pictures and click through and links to profiles of trades. So we are working on, re-improving or improving our directory product. We have our get quote service that we do, and we'll continue to develop and optimize that product. But there are other ways to connect with trades, and they include what we call a double accept process. Many platforms that are in this category globally do offer it. The business that we acquired in New Zealand, Builders Crack, yes, that is their name, and it's a great name. We love it. Have what we call the double accept. That's an extra curation in the process of connecting with the trade, where the consumer makes another vetting of the trade in the connection process, but it works really well when you work on larger projects where you do want to take a little bit more time to review and look at the type of trade that you want to work with. And we're also seeing globally and domestically with some of our partners through Bunnings and what we've seen in the US in Angie with Handy, is that there's a whole bunch of consumers that want fixed price services. And in terms of fixed price services, that works really well for jobs that are in the range of around $200 to $1,000, where you can scope out the work and make it a very standardized service, accept a single price, a standardized price for that service. So for example, today we offer through our Bunnings partnership, fixed price services for an installation of a fan, heat lamp, exhaust fan, lock installation, sink mixers, and the like. And they're all done at a fixed price right across Australia. And we know that customers want that type of service. It's not all the services, but there's somewhere between 10 and 15% of service requests can fall into a fixed price solution. And what we know is that different stages or different types of services can generate different take rates. So the percentage that we generate of the work that's created. Now, just to remind everyone, we don't take a commission. We're not a commission model. We're a subscription model. But then when you take our revenues and divide that over the work that is generated, you get what's called a take rate. And in our current product offering, our take rate is quite low. However, if you can improve and provide varied solutions for customers on the journeys that they want to go on, you can improve your take rate, which is what we're talking about in the right-hand vertical column. Let me talk to you a little bit more about Tradiecore. So one of the things that we realized was that when trades get very busy, the need for the main Hipages service becomes less prevalent. And we certainly experienced that and have experienced that in FY22. We made a decision a couple of years ago to buy and then improve and make a very simple mobile-friendly version of a field service software solution, which we refer to as Tradiecore. That product is in market. We are rolling that out and making that available as an inclusion of the subscription that our customers are paying for us. So it's an included service as part of their subscription. We will probably utilize some more credit on their accounts as they start to adopt the product. But field service software for everyone's, to bring everyone up to speed on it, is the scheduling, the quoting, the invoicing, the business insights, and for us also very important, the integration between Hipages and Tradiecore. So if a job lead is accepted by a trade in the Hipages app, that lead will appear in Tradiecore, and that can be followed all the way through to the next stage of how the work is delivered for a customer, particularly the administration component of that. Product is live in iOS and Android. It's mobile first. It's effectively a CRM system for trades, and we believe that that's going to help them manage and run their businesses better, become more productive, and make overall the Hipages Group product offering and suite stickier. We also, during the year, acquired Builderscrack, which is the business I mentioned earlier in New Zealand. Builderscrack has 40% market brand awareness. The name seems to be working in New Zealand, so we'll be sticking with that brand for now. It is a different model. It's what we call a double accept model, which I mentioned earlier, where there's additional curation by the consumer as they go through that vetting process of selecting a trade, and then they work on a success fee after that double accept model. So very, very fair system, however, leaving quite a lot of revenue on the table that doesn't go into the business. And so we see some really big improvements and potential upside in moving to a subscription model in the future with that business, and we're working on that as we speak. In terms of just a bit of an overview of our results for FY22, overall very challenging macro environment to operate in FY22. It seems like only yesterday, but people seem to forget that this was just yesterday, or not really yesterday, but over the 22 financial year. The industry received a number of shocks. The trade industry, that is, the market, particularly in the Sydney and Queensland and Melbourne markets, which are some of our most important markets, were really restricted in working. So trades were actually unable to work. And coincidentally, in the Sydney market, in the 8 LGAs that were locked down, something like 40 to 50% of our trades that are our customers in the Sydney market lived in those LGAs, which we didn't know about till the event occurred. And as a result, we had to pivot and adjust our strategy and plans. We had to provide some concessions for our customers, issue additional credit, rolled out some features like a pause function. And for consumers, we also had to introduce a feature, which is a COVID safe badge, which now seems so old and outdated, but was something that we had to do during the year. A lot of work was not able to be done in those 2 to 3 months, and then opening up out of the restrictions went into the busiest time of the year, which is typically before Christmas. And so trades became inundated with work and really busy. We were then subsequently presented in February with floods, which created a very, very busy market where a lot of work was needed to be done by the trades. And then we also then started to see labour and material supply shortages hitting the industry, taking longer to complete work. We are seeing some really positive signs, and I'll give you some color on what we're seeing in FY23 and what our expectations are. Despite all of that, we delivered growth. We have maintained a healthy balance sheet. We completed 2 very significant transactions, one of them being the acquisition of Builderscrack, and the second one is we invested in a business called Bricks and Agent, which is a technology solution that gives us access to the property management side of the marketplace, which was on that ecosystem slide, which we had previously not been able to tackle. Still delivering EBITDA and, managing and maintaining our balance and cash flows. So overall, very proud of the results that we delivered. I've never seen in the 18 years that I've been in the business 3 to 4 major shocks in 1 year. Normally it would be 1, maybe every 2 to 3 years, and you work through it. FY22 was a surprise, and kind of glad that's over, and I'm really excited about FY23. So here are some of the metrics. You can see we achieved growth, MRR growth, and we also maintained our EBITDA, and our operating cash flows were relatively healthy. Obviously, we would have wanted it to be better than that, but we really can only control what you can control, and I think we did an outstanding job, all things considered, and it talks to the resilience of the business. Some more detail on the metrics there. Probably don't need to go into huge amounts of detail there. You can look at the slide deck. I'm sure it's being shared later on. For those of you that don't know, in the group, we have over 34,000 trade businesses. Our average ARPUs are about $1,800 per customer. And we processed over 1.63 million jobs in FY22. So very significant player in the market for trade services. And what's not on this slide, and I don't know if we talk about it here. Oh yeah, we do. We're very involved in the marketing and integration on the block. That's been incredibly successful for Hipages' business. We have some very strong awareness. Some of our tradie awareness levels are sitting now at over 65%, and our consumer awareness is 60%. So 6 out of 10 people or homeowners in Australia would know about Hipages. And that's really been moving quite strongly since we've made some major investments in above the line advertising and marketing. And that's been great for us. In terms of building consumer trust and brand awareness, you can see that our volumes in job flow have continued to grow. The brand awareness levels have really demonstrated that we can get people coming direct to our business. So over getting closer now to 80% of our jobs are through unpaid channels and 20% from paid. If you go back 4 or 5 years ago, we were paying probably over 55% of our jobs. So, if those graphs went back a couple of years further, you would see that we are really making moves in building our awareness in the Australian market for our unpaid and building our brand. And also repeat customers is an important one. So you know that your marketplace is healthy when your consumers are repeating through the platform. So let's talk a little bit about the outlook. That's a very, very busy graph on the right-hand side. Probably should work to simplify that one, but there are some really important metrics there and tells the story quite well on what I was referring to earlier. Probably this is the last slide before we open it up to Q&A. So I probably just need a minute to walk you through and talk you through what we're seeing in FY23. So I'll probably put our focus closer to the right-hand side. So one of the really important indicators that we look for in the market is for qualified leads. So trades that want to come onto our platform. And we've been seeing in the last few months, and this has continued into August as well, and into September, is that trades are coming back into our platform, and we are now seeing record numbers of qualified trades wanting our services, which tells us that the market is starting to return back to balance. The catch up in terms of the workload is already starting to happen, which is great. That's that orange line that you see, the big jump up at the in the end of July there, and probably dropped a little bit in August, but it's still really high and at record levels and continuing, as I said, into September. In terms of the job volume, we're also seeing that some of that job volume is starting to ease. We were seeing huge numbers of jobs reaching to points that we were not able to service those jobs, which is also on one hand, a very difficult space to be, because we can't fulfill our promise to consumers. But bringing that back into balance and dropping that a little bit is actually a good thing for us. We've also been doing some measures to improve the quality of the jobs for our trades so that they're not wasting time chasing jobs that aren't really verifiable real people. So we've put some things in place to make our job quality better. And we've also seen the credit notes that we were giving out quite aggressively to maintain and support our customers during what was a difficult period. So that's that grey line that you see in the left-hand side of the graph, returning back to sort of normal levels. We generally issue some credit notes when we upgrade customers and little bonus credits. And when we have some nice features in our subscription product that allow customers to pause. So we issue some credits for that when they choose to pause their subscription for up to 2 to 4 weeks at any given time. We offer that a couple of times a year for them in a 12-month cycle, which is appropriate for the industry. We are moving towards an environment where we're managing and looking to grow our cash flows cash balance over the next year or two. There's nothing really on the horizon that I can speak to around M&A, but we always are looking at opportunities. In terms of the presentation now, I'm open to Q&A. Please open it up to the audience, Mark, for questions.
Thanks, Robbie. We've got 2 from the audience, but I just want to tackle one that was emailed in ahead of time. Somebody who couldn't join us this morning, but is going to watch it back on YouTube. They wanted to know: is there a type, for the want of a better phrase, a seasoning of the tradies book over time? So, in other words, year 1 they take the very basic like starter package, but by year 4, all the tradies that came on 3 years ago or 4 years ago, they've all kind of moved onto the premium model, or they've like left the system because it hasn't worked for them, or they don't feel it's working for them. Just in terms of that tradie journey of going from the initial starter package, day 1, to coming out as a kind of in one of those premium packages, do you have any data on like how long it takes them to get to that like kind of premium level, given as you said, most plans are annual?
Yes, so probably just be good. So as far as I understand the question, just to probably give some color to the audience as well, we actually have quite a meaningful sales operations team. Due to the nature of the industry, relatively unsophisticated, we usually have to do like what's called like a needs-based analysis type sale process. So a tradie will register their interest in our platform, and then we'll ask them a whole series of questions. It's kind of difficult to give like a straight answer. I know that people want to hear, oh yeah, every customer buys the $69 package and then every year we upgrade them up to a different plan. In reality, it doesn't really work that way. We have all different types of trade businesses coming in. It's not a homogenous product or service as well, which is another complication. So we have 200 types of parent categories. What I mean by that is there's painters, there's cleaners, builders, and the value of the service that is relevant for each of those industries can be higher or lower. So for example, a cleaning job is much lower but more recurring, but still over a time significantly lower than say a painting job that, you know, maybe a customer services the eastern suburb of Sydney, where one job alone you won't be getting change for $10,000 to $20,000. So you've got to understand the category, the type of work that the businesses are, and that what stage are they in their business. So for example, if it's a new business, they may need a lot of work from us. And if it's an established business, but you know, looking to fill their books with a bit more work, or someone that's more entrepreneurial and wants to grow their business and add a few more vans on the road, or more operators in their business, they may have more need for our service. So when we do our needs-based analysis, the average ARPU of a new customer is not the $69. The average customer comes on at around the $160 to $180 range. You can see that you're going to have some customers that are coming on the $69, and you're going to have some customers coming on the higher tier plan. Now, the plan is obviously over time, as I mentioned earlier, as we evolve our services, is that trades will release more of their book to our platform because they trust our platform for the recurring work. Consumers repeat and continue to post their jobs in our platform. So we will obviously want to push trades into higher plans, but also add more value into the plan. So they'll receive more credit, and that credit can be used for other services, including our Tradie Core solution. So over time, we do want to progress customers through that product. There is churn in our space. The question didn't allude to churn, but just to give a bit of explanation on churn, there's a high exit rate in the industry. Somewhere between 17% of trade businesses exit the industry, but there's more inflow of trades every year, which means that the overall industry does grow. The exit reasons are usually because retirement, injury, subcontracting, just taking a break. And that's why we actually introduced that pause feature I mentioned earlier. So it's a difficult question to answer because it varies by category and nature and size and the expectations of businesses. Yeah, we have a higher than basic price point, but we do progress customers up the plan over time.
Okay, and then what is, from the audience now, what is the current uptake of Tradie Core? Is it priced as a premium offering or embedded into the subscription fees?
So today we're offering that for free for 6 months for all customers that are on Hipages and all new customers that join. We haven't got full feature set ready yet. So one of the features that's very important, and we're literally imminently about to release it, is the Xero integration. So that's the integration into accounting software. So that's been requested quite a lot. And then the next feature is to be able to accept payments on those quotes and invoices. So we've already built the payment solution in Hipages business, but we will be taking that solution and integrating it into Tradie Core. We probably have just under 1,000 customers now using Tradie Core. And so we're moving to the 100 to 1,000 range. So we've demonstrated that the product is user friendly. Customers want it. The next phase of our program, once we've rolled out a couple of those features in the next 3 to 6 months, is to aggressively grow the uptake of customers on Tradie Core. Our view is that if we can help businesses be better business operators, we'll reduce the exit rate, give them more capacity to do more work, allow us to deliver more services to consumers, and also create an overall stickier platform as they take on more of our services over time. You can imagine with Tradie Core eventually that procurement and OH&S, equipment hire, are all things that could be added value services that can be integrated into the platform, and will deliver on our mission to expand the service offering.
And then very quickly, because we've got about a minute left, and I know our next presenter is ready, but a quick compare and contrast between Hipages and Angie is the next question from the audience.
Yeah, sure. So Angie in the US is the largest marketplace for trade services. They also operate out of Europe and have the #1 or maybe either #1 or 2 platforms in America and Europe. Angie's actually very similar because they are category specialists like us in Australia. There's really no one that's just a category specialist like us in Australia. There are a couple of other players, but they're more broad-based or labor hire platforms. Very similar. Angie's a bit older than Hipages. They've been around for nearly 24, 25 years. Primary business is their leads business, like us. They also offer field service software solutions and have gone quite aggressively into their fixed price solutions, all the way up to massive projects for renovations. So very, very similar business. We watch what they do quite closely. But nothing more to add on that one. Very similar.
Yeah, perfect. Thanks, Robbie, and thanks for coming back in to give us an update on all things Hipages. And we'll keep an eye out for further updates throughout the year, and hopefully we can get you back in maybe early 2023.
Happy to. My pleasure, and thank you everyone for your time this morning. Have a wonderful day.
Thanks, Robbie. If you could please
stop sharing.
Yep. Yeah, you're sharing. And we have Rod Bishop from Jayride, I know, standing by. Your screen's coming through now, Rod. Looks good. You're good to go, Rod.
Thanks, Mark. Can you hear me all right?
Yeah, the audio sounds good.
Mark and everyone in the room, thank you. Jayride is pleased to present a record annual result today, showing our company as fundamentally improved and more profitable and outperforming the travel recovery. We're winning market share, we're delivering major milestones, and we feel like we've got a once-in-a-generation opportunity to build the world leader in rides for travelers. So good morning and thanks for coming. This period is all about the results. Today I'm going to present to you some big percentage growth numbers. I'll begin with 30 seconds on who Jayride is, then we'll talk about the result. And then we'll spend a good amount of time talking about outlook and what comes next in terms of the macro and in terms of Jayride's growth. So for those who don't know us, Jayride is a travel technology platform at an early stage in a long-term growth trajectory. We sell rides to travelers, and by rides I mean, private cars, airport shuttles, ride-hailing companies, brands you know and love, and we sell those B2C through jayride.com, but we also sell them B2B through the largest online travel agencies and travel management companies in the world. So Booking.com, Expedia, Flight Centre Corporate Travel Management, Rome to Rio, Skyscanner, Kayak, the list goes on. If you have a travel brand and you're looking to make ancillary revenue, Jayride has a solution for you to turnkey the entire world of airport transfers to make every one of your travelers' itineraries door-to-door. So we're about 50% B2B, 50% B2C. COVID was an interesting experience. You can see in the graph on the right-hand side, around about 6.5 years of double-digit percentage quarter-on-quarter growth every quarter right up until the onset of COVID. And then you can see the recovery story that's come through. And that's why this period is all about the result. Some large percentages to get you started. Record revenue growth, record contribution profitability, record positive cash flow after standstill operating costs. So that's 327,000 trips booked for the financial year, 211 of those in the second half, so that's up 216% versus prior period. 2.6 million in net revenues, 1.7 million of those in the second half, that's up 237% versus prior period, and 1.2 million in contribution profits, with its 870,000 of those in the second half. And that again is up 353% versus prior period. You can see in this set of graphs here, improving unit economics, and this is really all about how our profitability has been improved throughout the pandemic. So net revenue has grown, contribution profit has grown faster. Net revenue there in the second half, 208% versus prior period. But the contribution profit, so that is our yield after all of our variable costs on those net revenues, is up 275% versus PCP. And that's our highest profitability yet by a multiple. Like, this is a significantly more profitable business than we ever were pre-pandemic. As a result, we've hit a really key inflection point in the fourth quarter. Jayride is now cash flow positive after the standstill operating costs of the business. And that's for the first time, and that's set to expand further. So when I say standstill operating costs, I mean the costs required to run the business. In June of last year, Jayride put together its largest ever capital raise. And so we've got a mandate to be investing in growth, and we've got a healthy balance sheet with which to do it. When we talk about standstill profitability, we mean setting aside just for a minute those growth investments and putting those to the side. How is the underlying business performing? And so we really want to draw attention to the underlying business, noting that that growth investment is, I guess, discretionary, temporary if we need it to be, can scale up or down based on performance. It's the underlying business that we're working to improve. We really want to be drawing people's attention to say, well, how much is it improving? And that's what you can see here. And so that's record cash inflows of 1.37 million of cash receipts from customers in Q4, and it generated a $500,000 surplus after those non-variable operating costs, which we can then deploy to self-fund accelerated growth. In February, we released what we would call at the time bold milestones beyond recovery. Pre-pandemic, Jayride was not at the end of its journey. We were on the way to somewhere. And so, throughout the pandemic, obviously people are focused on travel business recovery. From about February, we stopped really worrying about recovery. We were significantly more profitable than we were pre-pandemic. It is really about what is that next set of milestones in terms of Jayride's growth. And so we outlined 6 milestones: contribution, profit margin, net revenues per trip milestones. That's about getting our unit economics to be just absolutely perfect and ready for scale. And then standstill cash flow positive and standstill EBITDA positive is about that underlying business starting to generate the surplus to invest in further growth. And you can see the milestones that we've hit along the way. You can see also our progress towards, for example, $10 net revenue per trip. We're at $9.20 per trip in July. So we're very, very close to a number of these milestones. And from this point on, as we generate surplus to invest in our own growth, and our unit economics are very profitable unit economics, Jayride's story really becomes one about scaling passenger trips around the world. And we'll talk in a minute about those horizons of growth towards 1 million passenger trips and then onwards towards 10 million. That trips growth accelerated throughout the year. So you can see Q4, and you can see it's above pre-pandemic levels. It's also our highest ever quarter-on-quarter increase, and it's set to continue. International tourist arrivals, which is a major segment for us. Jayride is at its best for a traveler when they're going someplace they've never been before, when they don't speak the language, when they don't speak the currency. So an international tourist, great segment for us. That segment is set to continue recovery significantly and imminently. In particular, we're positioned to go and get it. You can see, for example, pre-pandemic, the amount of our business that was in Europe and Asia, sorry, not Europe, Oceania and Asia, featured there in the 2 blue colors. And I know you must be aware anecdotally of the reopenings that are set to happen right now. So whether that's Pacific Island destinations or Asian market destinations opening to international travelers, our content's in market, our channel partners are in market. We're all waiting for the gates to open and the travelers to come flooding in. We think that's a very imminent thing over the course of the next 2 and 3 quarters. You can also see the amount of market share that we've gained in Europe. Pre-pandemic, in the Q2 of pre-pandemic, 17,000 travelers for the quarter in Europe, not a significant share of our business. And you can see how that's grown 5-fold, now 70,000 travelers in Europe in the previous quarter. So that's a massive share gain. And you can see here the Jayride market share performance overall in green and in Europe in yellow. Jayride is outperforming the recovery. We are winning market share, and we're doing that with a superior offer for travelers, better content, that's better rides to more destinations and more prices. And throughout the pandemic, also really focused on expanding our traveler offer. And that is, better vehicle classes, higher service classes. It's both great for the traveler and also higher average order values for us, higher net revenues per trip for us, better customer experience leading to more traveler retention for us. In Q4, launching those through the biggest channel partners we work with. So that's like Booking.com, Car Trawler, these sorts of guys starting to get that and be able to sell it in Europe for us. That's the thing there driving those market share gains in Europe. And it's really set to continue. So overall, I guess in summary of the result, fundamentally improved and more profitable as a company, outperforming the travel recovery, winning market share, delivering a series of major milestones. I won't go through each one of these, but we're a growth company. We're continuing to enhance the platform. And so feeling, really well positioned to continue delivering those in the quarters ahead. Thinking about Jayride then in terms of, what's coming in the world and what we're trying to build. We'll move quickly onto Outlook. Jayride defines its vision as door-to-door rides to suit every traveler's needs in every country from anywhere to anywhere. So that's much more than an airport transfers business. When we think about what is the traveler's need, they're anxious, they're nervous, they don't have local knowledge, they don't know what price is good or what suppliers are reputable, they don't necessarily know how to get to their destination. All of those traveler problems extend beyond just their airport ride to, in fact, all of the rides that they take when they're traveling around town. And so as we think about those two milestones ahead, the 1 million and the 10 million trips, we really think about them in terms of two growth horizons towards delivering that vision of door-to-door rides to suit every need from anywhere to anywhere. And you can imagine Jayride at that second growth horizon, 10 million passenger trips booked, $10 net revenue per trip, your 100 million revenue, your 50% contribution margin, so your 50 million in terms of contribution. That's a lot of surplus that you can be investing to self-fund your own growth. Not only are you biggest, you're also investing more. You're kind of an undisputed leader in the category. You're overall cash flow positive. You're overall EBITDA positive. The unit economics are already there. We've already proved the operating leverage. So it's really just about that trips volume. To get to that trips volume, it's about expanding the way that we work in terms of markets and expanding the way that we work in terms of our traveler offers. When we talk about the markets, what that's going to be about is that's going to be about cultivating not just English languages, not just the few source markets we've got, but full multilingual and full global source markets. So when we think about steps towards that, that's about the launch of our European growth hub and the capturing of the Asian reopenings, potentially getting into some localization. So for example, Spanish language travelers, as opposed to just English language travelers. That'd be good for cultivating new source markets in Europe. And when we talk about the offer, we've expanded our vehicle type service classes, we've expanded our ancillaries. But when we start to go anywhere to anywhere or, in destination book and hail, you can start to imagine that travelers are not just booking 2 to 4 airport transfers per journey, but they're starting to book things like, non-airport destinations, maybe up to 10 of them. So consider that as a major driver of repeat purchase behavior, a major driver of increasing of average order values, major increase in net revenues per trip. In the first instance, you can just be cutting turf on some non-airport destinations or some extras and ancillaries, and we'll be building those foundations as we progress towards that 1 million trips mark. So with those little, shall we say, validation steps, those incremental steps at the first horizon, you'll also crest 1 to 1.5 million trips. And with our current cost base, that's a cash positive point where you're fully funding all of your own growth investment if we were investing the growth amount that we're investing today. So a little bit more just about the way that breaks down. Here's a view of Jayride around the world. We're definitely not an Australian business anymore. In terms of team, we're a global, remote first company. We have team all over the world. And you can see also our destination marks here pictured all over the world and a couple of wee notes about our strategies. In general, as I've said, Europe's about localization, Asia Pac is about reopenings, and North and South America, that'll benefit a little from those regionalizations. For example, if we're cracking Spanish and Portuguese language, that'll be good for LATAM and some of the larger travel brands we work with there. When we talk about expanding those offers, we've been getting great runs from the new vehicle classes and service types. It's really driving net revenue per trip, retention, traveler experience. But you can see over the two growth horizons ahead, a sequence of expanded offers that just make us the best rides platform for travelers. So that's things as you've seen, extras and ancillaries, non-airport destinations, last minute bookings, right until the point where you're literally, your wheels are touching down in a new destination, or you're getting off a cruise ship and you turn on your phone, or you've just come into cell phone reception and Jayride knows that you're there and messages you and says, hey, we see you're in a new destination. Would you like a driver waiting when you collect your bags? So very travelers focused lead gen there for us, something that none of the ride hailing companies do effectively. These expanded offers are successfully winning share. And so you can see here what our traveler product looks like and how you kind of progress through a search. And it's a very standard e-commerce type product, but as we invest more and more in it, conversion gets better, features get richer. We've really got incumbent demand. It's just about converting those. And you can see also here the kind of products that our travel partners, the biggest travel brands on earth, build using our technology. So this is the Booking.com, Rome to Rio, and Expedia apps featured, and that's Jayride content there that they're showing. You know, the number of quote requests that these guys are sending to us already far outstrips any of the milestones we need to hit. Our objective is not sourcing the demand, it's simply converting it. As I've said, with the right offers, the right prices, the right languages, these sorts of things. When we think long-term about the opportunity, you know, this is a story about offline moving to online, as it has with every other travel vertical. Consider flights, accommodation, car rentals. All of these purchases were originally offline. You know, you used to book your flights in physical person in a travel agent, and now you're doing it on a website. All of these verticals have all moved online. But when you think about the rides industry, the main flow remains you get off the plane and you stand in the taxi rank. And that's a horrible experience. Nobody actually wants that. And furthermore, all of the travel brands that those travelers have relationship with, whether it's the hotel or the airline, whoever sold them the ticket, would have really loved to have made that itinerary door to door, if only for the revenue, but also for the experience and the retention. So we really see travel brands these days leaning into rides as a battleground category, as a way to differentiate themselves. And the result of that will be that this industry moves online. Jayride here in a position to do it. And, you know, I guess as we imagine, you know, changed traveler behavior ex the pandemic, it's been a real catalyst to enhance, you know, travelers want to take on that sort of pre-booked for confidence and, you know, avoid crowded spaces like the London Tube and such like this. So in the very immediate term, the thing to be watching is that Asian and international tourism recovery. A lot's been made of how markets, travel markets in general, are getting close to their pre-pandemic levels, but that's not everywhere. For example, Asia Pac is lagging. You can see on the right-hand side here that the Asia Pac recovery is still going to take, you know, at least another 12 months, and all of that is going to be tailwind at our back, noting that we are already above pre-pandemic levels. Every single traveler that takes to the skies again for the first time is incremental for us. The other thing to note is that that's not a universal recovery across all segments. And the place that we are best, which is international tourism, again, you must know anecdotally that that hasn't fully recovered yet. Japan, for example, a great international tourist destination for Australian travellers, still almost entirely closed to tourists unless you're on a package holiday. Right now, Vanuatu has just opened up, like in the last 2 weeks, to accept international arrivals. You know, these sorts of things are imminent. They're happening right now. And we believe that's going to be, again, a major tailwind at our back in the immediate term. And so just to, I guess, conclude with a bit of outlook and summary, fundamentally, we're improved and more profitable than pre-pandemic. It's a much better company than we were in 2019. We're proud of the work across the pandemic. We've got the highest contribution profits in our company's history. That's up a very significant 353% versus prior period. We have trips above pre-pandemic milestones. We've hit inflection points around cash flow positive and starting to self-fund our own growth costs. We're outperforming that broader travel recovery. We're winning market share, and significantly in places like Europe, which really makes us believe that we're about to go through those similar significant gains in Asian destination markets as they reopen. So towards, you know, that future, as that recovery is coming through, we're going to continue to execute our growth strategy. You know, we're making disciplined investments from within our current cash resources to become that world leader in rides for travelers. We continue to see traction that supports those raised ambitions, whether that's increases in market share, our scale, our profitability. And so we're on towards those two growth horizons of 1 million plus trips where you start to be fully cash generative, and then 10 million plus trips where you are, you know, universally the largest player in this vertical in the world and investing more, growing faster than anyone else can compete with. So a very strong start to financial year 23. You can see July's numbers there, which run rate to our largest quarter ever, and also hit that standstill EBITDA positive for the second ever month. That's continued in August in terms of standstill EBITDA positive. Disciplined growth investments will continue to be made, and we're positioned to become a still more larger and more profitable company. So thank you everyone for listening to me speak, and thank you, Mark, for the opportunity.
Thanks, Rod, and I'll just say thanks for coming back on again. I just want a couple of questions. One is the 50% contribution margin that you talk about. Is there scope for that to increase? You know, as you go from this $9.20 to $10, and then the 10 million trips are. Is that kind of where you think it's going to be at now? It might be 52 one year, could be 49 another year, but by and large it's going to hover around that 50, 52 level I see there on that chart, even as you scale.
That's a really good question. Yeah, I describe 50% margin as peak margin for us because it's a margin target that we've never previously achieved, and then here we are, and we've now done it for 2 consecutive quarters. It's as a result of many years of work, even across the pandemic. That work has been kind of obscured in the numbers because refund rates during the pandemic were elevated. But now as they start to revert, those refunds, which is, no longer a cost to us, start to manifest in terms of increasing net revenue per trip, which flows to contribution margin. Similarly, those expanded traveler offers with higher average order values, higher net revenues per trip, that also increases net revenue per trip, which also flows to contribution margin. We set our milestone of $10 net revenue per trip. That's where we were pre-pandemic. But when we think about those premium vehicles that we sell, those often sell at maybe a 40% premium average order value. So, and we still have more offers to launch. So, how high can net revenue per trip go? 12, 14, 16, we don't know. We're going to keep experimenting with the value we can add to the traveler. And all of that extra revenue drops to contribution and into the margin because it doesn't necessarily incur extra cost to sell a larger cart. So our strategy doesn't need to be to achieve extra margin at that point because it's already, as we've pointed out, to the level of funding all of our fixed operating costs. Rather, our strategy is going to be to reinvest into advertising and marketing all of the extra margin that we yield. So you can imagine us, for example, doing more paid promotion, doing more display advertising, being for sale, advertising airports, physical, but also digital, whether that's coupons for travelers, whether that's kickbacks for travel agencies, and all of that, I guess, variable advertising and marketing cost, we can be deploying that out of our contribution margin, maintaining 50% contribution while accelerating trips and revenues at a much faster rate.
I just want to go back to the Europe experience over the last 6 months, and you talk about the huge kind of, was it 4 or 5x growth in trips. Who are you taking share from there? Who, I guess, and then it's a more broader question on who are your major competitors in this space more broadly.
I'll also give you a bit more context as well. So in 2019, Jayride rolled out globally. We'd been operating in just 5 countries. We rolled out to 110 countries. And primarily that was a Europe rollout as well as an Asia rollout, just making sure that we served every destination that travelers go to. We serve now airports that are 95% of the world's airport travelers that they pass through there. And then, of course, late 2019, we've completed that rollout. We start to sign up the travel brands. We all know what happens at the start of 2020. And so, I guess that infrastructure that we built, that market access that we built, has all largely sat latent until all of a sudden you start to see the reopenings. First in Europe, here are the numbers to prove that that infrastructure has worked, and then imminently in Asia. And so that's why we have kind of such confidence that that Asian market recovery is going to be great for us, because you start to see, well, it was a 5% increase in share in Europe. What can it be in Asia? Can it be the same? So the fundamental here is that we simply didn't operate in those regions effectively pre-pandemic, and now we do. And so when we think about where that share is coming from, well, first, online to us is just a fundamentally better experience than offline. Nobody really wants to stand in the taxi rank. If you can find someone online and on a third-party platform that gives you reviews you can use and trust to make the right decision, pre-purchase with a great cancellation and refund policy, you'll do it. Especially if that comes bundled through, the travel brand that you're already buying a flight or a hotel. This sort of offer, it's new to market, newish. There's not really an 800-pound gorilla in our industry that's well known in the same way that, say, Booking.com is well known for hotels. So for many of the travelers that we're encountering in Europe, this will be the first time that they've ever seen an online offer like the one that we offer. And so at the highest level, the online space and Jayride as a part of that, we're cannibalizing the taxi rack. We're bringing the offline to online. In the more micro space, Jayride's the only publicly listed business that does this in the world. And what that means is that we've been able to kind of, stay capitalized, pay refunds to travelers, pay transport companies their full clip. To the extent that there's online competitors, they were really seriously damaged at the onset of COVID in 2020. And by and large, they still haven't done those things. They still haven't issued refunds to travelers or paid their transport companies. And so, that's had, I guess, as you'd expect, really bad damage incurred to their brand reputation. They can't get the right prices from suppliers anymore. Their travelers didn't come back. So to the extent that there were travelers who already had an online alternative in their back pocket that they used, Jayride's come through the pandemic with a superior reputation and just, as a better offer for them. I'm happy again to talk if we want to in more detail about those, but I guess the stories of schemes of arrangement, the stories of Chapter 7 bankruptcies, there's, just a train wreck there for some of the other brands in this category. And, for Jayride, we've sailed through and we've maintained the trust and kept the relationship strong with all of our parties.
And just on the parties and the move to, different languages, is there like a major, Spanish language version of Booking.com that, you want to integrate with, but it's, getting all the language localization done on Jayride first before it can integrate? Or is it as simple as doing the language side of it on Jayride, and then it's just plugging it into Booking.com and Expedia's localized Spanish versions?
You're right. It is as simple as, localization is a well-solved problem by travel brands, and we simply need to copy that playbook, starting with just a few languages doing them very well. But ultimately, Booking.com themselves operate in 40, 50 languages. And so, in the first instance, again, that demand is incumbent. Booking.com wants us to be multilingual. Rome to Rio wants us to be multilingual. They've got travelers right now requesting quotes in non-English languages that we are then kind of not responding to, not serving. I think the sheer number of quotes, although I don't typically stand on this number, I mean it's tens of millions a month in terms of the passenger trips that we are quoting at the moment, and we just have to be there to respond. So when I say localize, I mean convert that incumbent demand by being in the language that the traveler wants us to be. And then beyond that, you're 100% right. There's absolutely Spanish language OTAs that then we can go and strike a relationship with. We already, for example, did some work with Despegar in LATAM, manually converting all of our pickup instructions to Spanish language and Portuguese just as a test. And it was fantastic. And so making sure that we've got, I guess, a really well-structured, really well-systemized approach to multilingual on the full platform, it's an obvious next step to take. And again, we're investing to do so. We've launched our European Growth Hub. Our new Chief Growth Officer, Darren Carbine, is based in London. He's recruiting his European team. We're spinning up multilingual customer service. It's underway.
And then I don't know if this comes under ancillaries and extras, but partnerships kind of around major events. I'm thinking kind of just the sporting ones. You've got Rugby World Cup happening in France next year. Doing a deal with the ATP to like cover Australian Open, Wimbledon, French Open, US Open on the tennis side, or World Athletics Championships where Jayride is the kind of promoted partner in terms of getting all of these fans to various stadiums scattered across the host countries, or just handling their travel when they get on the ground to and from stadiums, to and from airports, or wherever they're arriving. Is that part of the plan now that I guess people can travel to these big international events on the sporting side?
We're open to all kinds of partnerships, Mark. Absolutely, we can turnkey this into anyone who wants transfers. A fun story was last year, Faro in Portugal, home of the Champions League's final. All of a sudden, Faro got turned on where everywhere else was locked down to English travelers, and all of a sudden it was 6 or 7 times we've ever seen in Faro before. And so, when the travel conditions are right, including when big sporting events or other things send travelers to those places, 100% of Jayride's in market with the right supplier at the right price and the right service quality, it's what travelers want, and we can sell it.
Okay. Rod, I know you have a busy day, so I want to finish exactly on time and not to make you late for your next engagement. So thank you very much for coming back in and giving us an update on all things Jayride. And yeah, if anybody's traveling internationally in the next 6 months, be sure and check out the Jayride offering.
Thank you, Mark. Thank you, everyone. Appreciate it. Have a great day.
Thanks, Rod. And I do know we have our final presenter standing by. Danny, if you want to start sharing your screen, I'll let you know when I can see the slides coming through.
I'll just do it. Let me just do this. What do you think? Do you see it now?
Yeah, that looks good, Danny. And your audio sounds good as well. So ready to go when you are.
Great. Good morning, everyone. And thank you, Mark, for having us on Coffee Microcaps. It's a pleasure. We're going to spend the next 15 minutes or so just, giving a brief overview about the business itself and what we've been doing in the last, predominantly the last 5 years, and then go into the H1 results we just published. The presentation that I'm showing today was just published on the ASX this morning, so you're welcome to continue and learn from it later. Just to be sure, Mark, are we in good audience? Everybody,
yeah, I can hear you perfectly. I can see the slide, so it looks good from my end. I'm sure people let us know if it doesn't on there.
Perfect. So, really, who is Shekel? We like to think of ourselves as a global market leader in advanced weighing technology. It's a 50 years company that was always driven by technology that it's developed predominantly on a sensor level. And what we try to do today is take this capability that we've been using for decades and selling and shifting into a more value proposition to the retail space. And what you see is a combination of a sensor technology plus AI, bringing completely new solutions to the retail automation or the way we shop, which is our vision for the next few years. The business is really divided into, from a customer-centric perspective, to 3 market segments that we are still focused on today, which is one is the healthcare, the other one, which is the growing one, which is the retail, and what we call industry, which is predominantly projects that is done in Israel. What we saw in the last 6 quarters, actually, or even more, is continued growth of each of these segments with a particular focus on the retail space. And what we just reported was record revenue for $13.1 million US for the first half of 2022, representing 23% growth compared to last year. So what we see is selling to clients like Datalogic, Toshiba, Fujitsu, Zebra is a new client. And what they do is to take our weighing capability, put it in their self-checkout, and then in turn sell to their clients, which are the Walmart of the world and the Home Depot and Carrefour and others. So last year we sold roughly 40,000 of these units. The first half of the year is again representing a growth for a total of 5.1 million US, presenting a growth of 34% compared to the previous year. And what we see here is almost an exponential growth of the need for self-checkout. If you see any supermarket chain, we used to have 5 or 6 manned checked out and then maybe 2 self-checkout. It's now completely changing toward the self-checkout. You see this predominantly in grocery retail, but in the Bunnings of the world, and more retailers are moving into automated payment systems, which we support through our system, through our technology. Won't focus too much on this. These are basically projects that we're doing predominantly in Israel. They represent anything from weighing luggage on the airport, on trucks on the road, agricultures, and so on. A very nice part of the business, profitable, doing very well, and also grew in the first half of the year. The business today, or the scale business, we like to call it maybe the traditional business, but it's not so traditional. It's now in the process of completing development and commercializing 2 new products. One of them is quite exciting. It's called a smart cart. We haven't seen it yet in Australia, but it's basically a solution that embeds self-checkout into a cart. So you'll take a cart in a supermarket, you'll weigh your products and scan them on the cart, and you'll complete the whole transaction on a cart level. What we saw is a trial that was at the end of last year, converting into the largest single purchase order of the business, a project for 5,000 of these carts that has started, will start delivering already in H1 and moving into deliveries in H2. So that was quite a nice surprise to see how the market adoption of this solution. It's a company called Custom8 that is working now on delivering 5,000 of these carts. Few of them are already in operation in few supermarkets. And we see this both in Israel and the US. We're now looking to growing this capability. We know of another order coming from for the same application, which is quite exciting on the smart cart. We think that's gonna have a big impact on grocery retail in the future. What you see on the right-hand side is Fast Track, basically a much better improved way to handle every product that we do on self-checkout, but predominantly fruits and vegetables. So every time you scan a fruit or a vegetable on the self-checkout, if we can automatically detect it, we saw some of it now already in the market. We just seem to do it a lot better. It's in final stages of implementation in a retailer in Israel. So we're looking to implement this product in early 2023. It's a product which completely based on SaaS model. So we use the optics of the self-checkout, and what we do is image processing and providing recommendation on what should be the product that should be clicked as the right product that the consumer purchased. Again, a pilot that is going to completely roll out this quarter, and we see already very good results coming from the analytics of the optics. We're now moving into a very different discussion, almost a different business altogether, if you will. What we found out about 4 or 5 years ago is that if we take our ability to understand sensor technology, this ability to weigh something, and if I'll combine a very complex mathematics and artificial intelligence, we can artificially create a new piece of technology. And I think that's very important to understand. Shekel was predominantly a tech company. And what we developed was an enabling technology, a talking shelf. Think of a shelf of a supermarket, and it's now talking to us in a real time in a very accurate manner. So what you see here is how the whole venture started. And it's a venture that started by being funded by the company itself. And that is your piece of technology, which is almost like an Intel inside. It's a piece of tech that is now an enabler. That developed into what we call the smart bay, or the bay that can actually talk to us. Eventually moved into also smart fridges, which the type of vending, but vending which actually has shelves in them, and you can open the door and take whatever product from them. We now have 2 models, one for Europe, which is called Innovendi Europe and Israel, one which is called Hubs, predominantly for North America, but also Europe recently. And the end game, if you will, is a complete autonomous store, a place where you walk in as a consumer, take whatever product you want and walk out. It is completely frictionless. You don't deal with cashier or self-checkout. It's all done frictionless. We have now the first store in the US open this January, in Atlanta. We have 2 of them in Paris, one open in Germany, one open in Israel, in a pharmaceutical retail. So it's quite a developing market for us. What's interesting from a business model is that when we sell these solutions, we sell the hardware and a SaaS model that kicks in as soon as we sell it. So it's I think they say razor blade, but you sell the technology, you sell the hardware, if you will, and then immediately a SaaS model kicks in. What we saw is that it took us about 2 years to develop the tech. Early in 2020, it started commercializing, and what we see since then is an exponential growth. So this venture alone reached $1 million in revenue for the first half of the year, which represent 165% compared to last year. And what we see is more and more demand for these products going forward. And I think that's got to be the stronger performer, if you will, from a growth perspective, and the engine that's going to take the business forward from a retail automation standpoint. Maybe 2 minutes about the tech. I think it's critical that people understand that we pretty much started with the tech as the key component of what we do. And basically, what you see here is a technology that was developed and now awarded 4 Gold Partner Awards with Intel. So if any of you go into Intel website and you key in Shekel Brainweigh, you'll see 4 Gold Partner Award only in the last 2 years. So when a giant like Intel look at your technology and validate it, it gives us a good and strong feeling that we're actually on the right track, and that very large companies are looking at what we do and validating it. It's both from the accuracy, flexibility, and affordability that we think that we bring to the market something which is so unique and such an enabler that piece of technology can actually take us for years to come. I would like to show this, this slide that actually show the ability to differentiate between Coke, Fanta, Pepsi, all 1.5 liter presumably, and be the ability to do it in a very, very high accuracy level. We had a chance to do this in Australia in a trial that we did here, and I think we were at these ranges of 99% detection compared to 50 or 60 with cameras. Which gives us a very good feeling that the tech is matured to a level that we can start utilizing it. Talking about a few of these products, Innovendi and Hubs are both smart fridges. What you see here is a new product offering altogether. About 150 now are in commercial in Israel. A very strong demand now from Europe, from a company called Colroy. What you see here are smart vending. The way the consumer interact with it, they put up a payment like a credit card or debit card that allows you to open the door. And here you see different products. There could be dairy, salads. We have now a few fridges in Sydney in some hospital that sells only vegan food. So the ability to offer healthy food and food that is placed on shelf is what makes it so unique. And this is what we see the strongest demand. Each of these units will sell for $6,500 to $7,000 US, and then a SaaS model that kicks in on a monthly basis. You'll see from the slide the commercialization started, and we see this predominantly in Europe and in Israel. Another 60 units that we just reported in the US. This is really cool. If any of you get to search Nourish and Bloom, Nourish plus Bloom in the US, a project that we did together with USD and some sensors of Hitachi is another partner that we work with on LiDAR technology, but basically a concept that says you walk into a space, take whatever you want and walk. Very new. People used to refer it as Amazon Go. We use different technologies, which we think is a lot more economical and much better from a detection perspective. And that's where we see the biggest growth. About 5 or 6 of them, these stores only in the last year. And we see stronger demand, including in our region here, to such solutions. Of course, makes the consumer experience a lot better. Let me see if I flip. And I think that that's maybe the biggest promise behind the company is that we call it data is the new oil. But basically, if I'm able to collect data from every shelf, on every supermarket, on every smart fridge, or from a lot of these units, my ability to then aggregate this data into a meaningful business intelligence is what makes it so powerful. So if we can actually understand how people consume products, whether they do it from a supermarket or from a smart card, or whether they do it from a vending machine, and we can understand how consumers consume grocery retail, the benchmark that we can apply to different locations, clients, customers, and this data going into people that prepare food, like your Hipages or A2 Milk or whoever is interested in the data, that's where the biggest growth, if you will, can happen when we start dealing with massive amount of data collection of a lot of product being consumed from a lot of locations. A bit about our first half year, 13.1 million in revenue, 23% compared to the year before, 4.7 in gross profit, and 4.7 million, sorry, in gross profit. And you see the figures. I think what's really critical to understand is that cash burn reduced. Shekel is kind of a strange story of a company that decided to do its own venture. And so Shekel for 40 years has been a very profitable company. About 160 employees, was always making money, and then decided to invest in this venture, quite a heavy investment in the R&D and commercialization. And we kept on burning cash as a result of this investment in the R&D. We now, for the first time, seeing that we're turning the curve. So for the first time, the cash burn is started to be reduced, and together with the growth in revenue and the cash burn reduced, we now see the path to return to our normal mode of profitability. So that's quite exciting to see that alongside the growth in the revenue, the cash burn started to be reduced, and that's the trajectory that we see going forward. There's a good research, by the way, that was just released by Ross, predicting the returning to profitability in 2023 and how the revenue is projected to grow. Quickly, how this in terms of number, Shekel traditionally has a stronger H2. That's normally because the pattern of ordering from companies like GE and Toshiba creates a momentum by they're ordering in the second half of the year and they're using it in the first half. So what we've seen for the last 7-8 years is that the second half of the year is stronger. We try to demonstrate it here in numbers, and we still grow half on half in the last 5 half. So we continue to project that the same trend will happen in the second half of this year, will again suppress the first half. And together with it, we talked about the cash burn. We anticipate this to go down dramatically as we continue to grow the revenue. We are pretty much at the inflection point where the R&D and the investment in R&D has matured, and we don't expect that it's going to grow anymore. And now it's about commercializing and project management in different projects around the world. And with the growth of revenue, the business is now returning into a normal operating mode, if you will. Corporate perspective, I think it's easy to see. It's about 150 employees. We're a tech company based in Israel with operation in Asia, 2 facilities in Asia, one that do some manufacturing in Hungary and one in Mexico. Now about 192 million issued shares, with a very strong presence of an Excel, a company from the US, which is a major part. Excel partners that hold 27% of the business, 2 partners from Israel, and the rest is held by sophisticated investors. You'll see the share performance has been quite disappointing, if you will, at 11 cents. The same research now put the business at a value of 37 cents per share. And this is the information on the corporate review. The management of the company has changed in the last 2 years. We have today Neil Leshem with us, who is the general manager. After years of operating in the 3M in the US, has arrived, returned to Israel 2 years ago. And I think under his leadership, we've seen quite a change in the way the business is structured and optimized, if you will. There was a good statement from him in the recent release. explaining the issues relating to logistics and supply chain and the challenges that the business faced in the last 1 year and how we're actually dealing with it and even take advantage of it. The company is led by Arik Shore. He's a very known chairman and CEO in the past. He was the general manager of Nuva, the largest food producer in Israel, $2 billion US in annual revenue. And we have Barak Nir, who's the key person covering the market here for us, and he's our CFO with a vast experience in management of finance. I think we'll skip it. It's already 20 minutes, and happy to take some questions, Mark.
Thanks, Danny. I just want to go back to the smart carting for a second. Does that also work on a hardware and software principle, or are you just selling the hardware on that particular product?
We're predominantly selling the hardware itself, but there are development in this field too. So it's a very new element for us. I think we reported the deal itself was for about 1.6 million US. But there's way to, in the future, combine our understanding of the hardware and the analytics. So if you put a product on a weigh system, I can actually understand its shape, but I can also understand how much it's weighed to give a much better detection of what this product is. In a sense, you allow people now to take a bunch of carrots and say, can I call it now? Or can I take organic bananas and call it carrot on the system? But there's got to be some logic that you can apply to understand whether it is the right one or not. So yeah, the answer is we start with the hardware, but there's analytics that go into detection that can be applied later. And then we're only in the early days of developing this product with the world, and it's quite exciting. There's going to be development in this area. Yes. And
then I just want to touch on the hardware software for the vending machines for a second. So you're saying one of these new vending machines, it's $6,000 to $7,000 US to buy one. So if I'm a major airport or a major, university, and I've got, 40 or 50 of these vending machines, what's my kind of monthly cost then for the SaaS portion of the vending machine? And what are they getting? Is it just so that, they get all the software upgrades, or do they get themselves the data analytics and, it's talking to their systems? Okay, we've sold this many cans of Coke through the vending machines on campus, and now we need to reorder this, or what are they getting for how much are they paying on a monthly basis per machine for the SaaS portion, and then what do they get for that monthly fee?
Okay, so first of all, the software supports predominantly the operator himself, so he knows in real time any movement of a product from any shelf in the machines, so he can plan his trips to the machine. He can understand that now you have only 3 yogurts left, so prepare the driver to take this. So it really allows the operator a much better way to operate these machines, have predictive analysis into what is coming. The other thing that we've seen is a much larger volume coming out of it. So I'll just give you an example. In Australia, we know that a vending machine normally sells around $600 to $800 a month in revenue. What we experience only in a few months is double this. So there's a psychic that says that, if I open a fridge door, it almost looks like my fridge at home. I'll take a lot more, and I can take a salad and so on. And that would create a dynamic by which the revenue coming out of these machines is much larger than your normal vending machine. The payment that they will pay depend really on the size of the transaction and how many machines they operate, but it normally comes to a few tens of dollars a month. So $30 to $40 US a month is how much they'll pay for the data collection, if you will. It's interesting. You mentioned, the locations where we see this. the company in Belgium that took 67 machines just for fitness centers, and within 3 months ordered another 40. So it was, and that just a particular segment for fitness centers. What we see in Israel is across the board in train stations, universities, a lot in hospitals, even normal residential where there's a lot of buildings. So it's almost like we try to bring the product closer to the client, which is not new in the industry. The whole retail industry is trying to go smaller and closer to clients. And we're pretty much riding on the same trend, bringing products, but not your Coke and snack, but really healthy products to wherever consumers needs to consume them. And that is where we think the big change is going to be, that the availability of products, of healthy products. You know, we're very surprising to see the vegan, but vegan in Australia is I guess less available on the go. There's a gap on the market on vegan food on the go, and that is what this particular customer is doing.
And then question from the audience: can you talk a little about your capital requirements going forward in terms of R&D, development, marketing, etc.? Will these be satisfied from cash flow, or will there be, you know, potentially need for additional capital? So I think, you know, the thrust of that question is, you know, in terms of the R&D spend that you've talked about in starting this business within a business, you know, have we gone past the hurdle of, you know, the major work is done, and now it's a question of adding bells and whistles and features here and there and upgrades, but you know, the real heavy lifting has been done?
Absolutely. The technology has been completely validated. We see this in commercial activities today. So we are absolutely confident in terms of the tech. There's always going to be improvement. iPhone 10 was always better than iPhone 3. But in terms of the heavy investment, it's done. Most of the focus today in terms of investment is improvement or doing projects. So if you do a retail, you know, a new autonomous stores, you'll need to send engineers there for the first time. So it's going to take the effort to bring these projects to life. And we normally use the same team, but we don't expect this effort to grow dramatically anymore. And now it's mostly about commercializing and doing projects on the ground, support teams, and getting the scale out of what we have created. In terms of the capital requirement, I would say that it's for the board to make a decision at a particular time, but there's no doubt that when the opportunities will be presenting ourselves in terms of a large volume of orders, we will need more cash to get it done, whether it's going to be done from the resources of the business itself or others, that for the future to say.
And then just on the smart vending machines, you know, it seems like they're working very well for, you know, that kind of fresh offering where it's the vegan food or milk or salads or whatever. Is that something that you specifically targeted? Or, you know, are these vending machines equally applicable to your standard kind of snacks and cans of Coke? You know, you can stock them in it, and rather than them coming out the bottom of the machine, people can also just open a door and take what they want from them.
Do you see this slide now?
Yeah.
Okay, that's an office building in Israel. They took only one machine in the beginning because they only wanted to sell dairy. And here you see the milk and the cheese and the stuff. And then they said, look, why don't we put others? And here you see the yogurt and the Chinese noodle. And here you see on the third one, the snack. So it's 3 machines on the same building, just growing through demand from the consumers. The nice thing is that it doesn't matter what you want to put there. And we've seen demand from people that want to put on mining sites in Australia, all the headset and the, you know, plugs for the ear and things that got nothing to do with grocery. We're completely agnostic to what you want to put in there. It could be a product for universities. It could be we've done it with a company in the US that it's like a Home Depot, and what they want to put is different product that got nothing to do with refrigeration. So the advantage of having shelves is that it's imitate exactly what you see on shelves in supermarkets. So we're completely agnostic to the product.
Okay, great. I just want to check, Danny, if we got any further questions from the audience. It doesn't appear so. Danny, thank you very much for, we'll leave it there because we're actually just a little over time, but thank you very much for coming back in and giving us an update. And yeah, if have you got your contact details on a slide here, Danny? If you want to just throw it up there quickly. Yeah, if anybody wants to reach out to Danny in reference to the RAS research that's done by RAS Group, they cover quite a few microcaps. For anybody who doesn't know them, I'm sure if you email Danny, he'll be able to send you a copy. Or is it available on the Shekel Brainweigh website, Danny?
Yeah, I think if you'll go into the, we have a dedicated website for investors. So if you go into shekelbrainweigh.com, it's, I'm sorry, it's not .com.au, but it's, I'll try to show it. It's .com, and there's definitely
yeah, there's a micro site that goes with it. If you click on investors, I know what you mean.
Yeah, so if you go on to shekelbrainweigh.com, that's where you'll see both the investor side, all the announcements, all the research that was done on the company, and this is actually the report from RAS, as you see, yes, placed the business on continued trajectory of growth and 37 cents this year.
Yeah, so if anybody wants to download that, I think it's a good, it'll give you a good overview, and it might help people on the research side on Shekel. Danny, let's leave it there, and for everyone else on the call, thank you very much for joining us again this morning, and I wish everybody a good rest of their Thursday.
Thank you, Mark. Pleasure to be in.
Thank you.